And it looks like we have a crypto question.
Yep.
A client wants to know what are the tax considerations for individuals engaging in crypto transactions and how can they ensure compliance with IRS guidelines?
Yeah. So it depends on what you're doing. Crypto is a thorny beast. So,
That's true.
so if you are just buying and selling crypto, like you would be trading a stock or a bond or something, then it's not that bad because it follows the same kind of rules. One exception is that there's no wash sale limitation for crypto, which could be really powerful. Um, but if you are doing anything else, if you are doing DeFi and you're in liquidity pools, or you're bridging tokens across different blockchains, or you're playing crypto games, or you're staking, and all these kinds of things, all these introduce complications. So fundamentally, you have to pick a method. And by method, last in, first out, highest in, first out. So it's because things are fungible. One token is the same as another in most cases. Then if I sell one Bitcoin, let's say, and I had three, well, which one did I sell? I don't know. There's just a balance, right? So you have to pick a method to track the tokens within your wallets, and you have to be consistent with that. That's thing number one. Thing number two is that if you are doing any of these more complicated things that don't really have an analog in traditional finance, then you have to track things as best as you are able. There are software platforms that claim that they can reconstruct your crypto transactions. I have yet to see one that can do it correctly with complicated things going on. Then it brings in the question of the fact that there is no tax law regarding cryptocurrency. What happened back in 2013 was the IRS just stuck a flag in the sand and said, hey, we're treating this as property, go from there. And most people have gone along with that. And for example, several years later, the IRS published an FAQ on what happens in this situation, what happens in that situation. And you can read through that and interpret. And it's all consistent with cryptocurrency being treated as property. For example, if you get an airdrop token, so you hold token X, because you hold token X on a certain date, other project gives you token Y. What is that token Y? According to the IRS, it is income at that point, and it's ordinary income. So in that kind of situation, you have to pick up the value of the token that you received on the day you receive it as ordinary income. And then whatever that ordinary income amount is, creates the cost basis for a future capital gain event. So if I receive the token January 1st, there's a certain for $100, let's say, and then I sell it on February 1st for $200. Now I have 100 of ordinary income and then I have 100 of capital gain. It gets complicated. The IRS also says that any exchange from one token to another is a taxable event. So if I have token X and I trade it for token Y, that's a sale of token X and creates a new cost basis for token Y, but that I might have a gain, I might not, might have a loss on token X in that transaction. Similarly, if you bridge a token, I have token X on Ethereum, I hand it over to a bridging service, and I get token X on Arbitrum or some other blockchain. Is that the same thing? Probably not. You're going to have a loss and then a gain on the other side. Same thing with liquidity pools. You give away tokens for nothing, and you receive a valueless LP token that has no market value and is worth zero. So basically, you took 100% loss on that transaction. You get into all kinds of weird stuff. Now, that's just level one, right? Level two gets into the fact that there has been lawsuits about like staking rewards. For example, there was a case out of the Tennessee district, I think it was, where a couple they were staking, I don't know, some coin, and they were getting rewards. And initially, they filed a tax return and they declared those rewards as income, and that went through. And then later on, they said, "Wait a second, that's not really income. It's not income until we sell those tokens that we received." Because their analogy was, if you are a bakery and you bake a cake, you don't pay tax when the cake is baked. You pay tax when the cake is sold. So the ingredients that come together to form the cake are irrelevant. It's just when I sell something to a customer, that's when a taxable event happens. And so they amended their tax return. The IRS approved the amendment, which was interesting. And then they decided to pursue pursue law to create tax precedent. And it got hung up in court and kind of never went anywhere, at least last time I looked. Level 3 of that whole thing is that we are now in a post-Chevron world. So meaning that there is no deference given to agencies without law. So the fact that the IRS said in 2013, hey, it's going to be this way, in a post-Chevron world, that's just their opinion, right? It's not a binding anything because there is no tax law associated with cryptocurrencies. Fundamentally, do your best. You are required as a US taxpayer to declare all worldwide income. So like the question is, what is income, right, in these cases? And it depends a lot on the specific situation of what it is that you're dealing with. And that's not even getting into NFTs and all this kind of stuff. It's complicated, and there is no clear answer at the moment. But do your best, be consistent, and that'll keep you somewhat in the clear.
That's because it's a general question, right?
Yeah.
So it depends
Mhm.
for this question too.
It always depends.
Yeah, it always depends. Looks like we have a Augusta rule question.
Okay.
Someone wants to know, how does the Augusta rule work and how can I qualify for it?
Yeah.